All right, good afternoon, folks. We're going to get started here. All right, well, thanks for joining me for this the afternoon session here. My name is Jeffries. I'm a data scientist here at FBN. I'll be giving you guys an update on recent work that we've been doing at FBN around farmland value trends and our research around their determinants as well. The work that I'll be sharing here is a collation of work across many teams here at FBN. So lots of credit goes to a diverse group of scientists and economists, and including the kind of FBN research and markets team here. So it's probably not surprising to anyone that recent trends in farmland values have seen a swift shift upwards. So we'll speak to some of those kind of recent trends, discuss some of the key drivers for those trends, we'll then describe some of the kind of key regional level insights and field level insights that we've been working to develop at FBN, kind of leveraging network derived data and statistics to help bring more transparency to the process of land valuation for growers. Next slide, please. And again. We're having some clicker difficulties, so I'll be queuing some slides here. On USDA's most recent statistics, we've seen some quite striking developments in the farmland market. This is, of course, not news to any of us here. Unilaterally, we've seen an acceleration in farmland prices across the country, averaging about 12.5%, with some notable outliers on the high side. Kansas up 25%, Iowa up 21%. And even as we look back, not just from 2021 to 2022, but back to 2020, those changes are even sharper. So the combined average increase in farmland value over that 2-year period has been 20%, and in some cases like Kansas, up even more dramatically, around 30%. Now, these are numbers that USDA develops on the basis of surveys, and they capture both farmland, which would include kind of cropland pasture, as well as the value of buildings. And these numbers give us a kind of a good kind of directional indicator on motions in the market. They come out once a year and provide us this kind of state level indicators that are valuable. So to give some context on these increasing rates of value, up 12% in just the last year, we can look back over kind of a long time period that USDA has been conducting these services and reporting on land values. To see that over since 1940, the average appreciation of farmland from year to year increases in value year to year are about 5.8%. So recent increases are, of course, well above the historical average. It's striking, though, that farmland values have very consistently increased over time, and part of that is due to the kind of one of the kind of nice financial attributes of land, in that it tracks inflation quite well as well. So as inflation has increased, so have land values to kind of couple those. So what's a question that's commonly on a lot of people's minds now is around, well, we've seen accelerations in land values recently. And in fact, as we look over the historical record, we've seen this happen on a number of occasions, where we've gone from kind of being below trend to kind of jumping above it for kind of extended periods of time. And we've seen then a kind of complementary slowdown in appreciation that often follows that. And we've seen this in the 40s and 50s, dramatically in the 80s, also in the mid 2000s. And so recently we're on the kind of increasing side of those swings, and many of us wonder what's happening, what might happen next. This is something that we care deeply about at FBN. Land values are kind of the core feature of kind of our farm equity, what we can kind of borrow from and kind of leverage, what we pass down from generation to generation. So keeping a kind of a sharp eye, and they're also the key for profitably scaling and extending the acreage in our operations. So it's key to have a kind of a keen eye on trends in these land values. So we've been building a set of new offerings that we'll be able to provide through the FBN platform to help us all kind of keep a better pulse on changes in land values in an unbiased and transparent way. So one of the ways that we're doing that is by aggregating public sales, farmland sales and transaction records, and providing those kind of summary statistics and those trends analyses on a monthly cadence. So there's no longer a need to wait for USDA's annual numbers, and no longer do we need to depend on kind of survey data to tell us this. We're able to kind of look directly at actual transactions to capture some of these key trends. So here's an example from a recent period where we, in orange, show our monthly level trends, and kind of green line showing the kind of overall trajectory with kind of blue points indicating USDA reported values. And we see that we're kind of largely correlated with USDA values, but are able to provide a much greater temporal granularity. Now, land values and real estate markets do move around quite a bit, so it's a non-trivial kind of analytics problem to try to kind of extract signal from all of the noise in farmland transactions, and that's part of what we can kind of offer, we can provide from the data science team to kind of extract the signal from the noise. So most recently, we're reporting October 22 cropland values coming in at $5,166 per acre, which would equate to an annual change of an increase in 8.8%. And we'll be releasing this type of reporting on a monthly cadence moving forward, so you can be the first to know when there are shifts in kind of aggregate cropland and farmland value trends that we all want to kind of keep a close eye on. So, of course, there are still these kind of lingering and open questions. Are farmland values going to continue to increase? Is farmland currently overvalued? Go ahead. And in order to explore these questions, to kind of develop some kind of an informed answer on them, it's key to look at the drivers of land value across a wide range of spatial scales. That's what we'll do next. Our key approach is to really focus on the fundamentals of farm economics that help us understand and unpack the drivers of land value, and intuitively these break down to expenses and revenue, and then kind of interest rates and inflation to kind of bring in a kind of a broader kind of systems macroeconomic context to farm revenue. It's no news that farm expenses have climbed in recent years. Here is a plot, again, from showing USDA data, this time from the Economic Research Service, that shows how current expenses above 2022 expenses per acre are well above the historical median, and may continue to grow. A recent crop budget report from the University of Illinois forecast expenses to increase 9.2% moving into next year, and this is largely driven by input costs. The headline item there is naturally related to nitrogen. Of course, there are other kind of key factors, but that's the elephant in the room. Nitrogen prices are largely tied to the value of natural gas. And there are myriad reasons why natural gas prices have continued to be at elevated levels. There may be some shifts in that pricing looking into the next spring and summer, if we look at the futures price for natural gas, which is a reflection of the market's opinion on where natural gas prices might be heading, we're seeing the market expecting a natural gas price of $6.30 in March, and then going down to $5.33 in April, and then kind of holding steady forward from there. And that's a far cry from the recent prices in the 8 range. So these are, of course, just forecasts. They're market opinions. These aren't facts. And in fact, it may be kind of too late for these changes in natural gas prices to kind of make their way through supply chains and onto the farm. But I wanted to kind of share this data point. Although prices of inputs have continued to remain at elevated levels, they've largely been offset by higher incomes as well to help catalyze high land values and an increase in land value growth. And here again is a similar type of plot where we're showing the kind of trend in the in a kind of a key financial metric over time. This is the expense ratio. That's the fraction of your income that goes to expenses. So in this case, lower values are better, and you'd interpret this as an expense ratio of 75%, means 75% of the money coming in goes to expenses. So our recent expense ratios have been kind of under the historical trend, which is kind of a signal that income is offsetting many of these higher expenses. However, there's certainly a lot of kind of uncertainty around how stable this will be moving into the future. We're in a period of high grain prices. I put this icon here to note that there are many kind of experts, and in fact sessions here at Farmer2Farmer where our markets team and research team will kind of do deeper dives on the trends and expectations in grain prices. So I'll just kind of point to that in passing here. But we are also seeing that recent lower expense ratios may have also been kind of supported by one-time government support along the way to the tune of $34, $35 per acre from pandemic relief. So overall, there's has been kind of an offset in the amount of money coming in. And this is important because intuitively enough, and the fact bears true in the data, as when there are times of many years, when there are multiple good years in a row, you're likely to have more savings, more opportunity for capturing opportunities for growing the operation, and that leads to kind of higher demand for kind of real estate investment or for purchasing and extending the farm, and that drives up land values as well. And so based on an analysis that we did in Illinois, we saw that over that 1940 to kind of present time, we found that the annual change in land values in percentage terms is correlated with the change in savings. So for every 1.25 percentage point increase in accumulated savings over time, land values increased by 1%. Again, not a headline, but it's an intuition that is born through in the data set that we have available to us to kind of help unpack the key drivers of land value. So based on these relationships that we've modeled in the data, we're forecasting that in the case of Illinois, land values may continue to increase at a rate of 5.5% in 2023. Farmer savings will increase by 5.5%, leading to a nearly 8% increase in land values in 2022. So to kind of bundle those key themes together, again, we're focusing on understanding the determinants of farm expenses, farm revenue, putting that together to kind of understand the kind of savings position of growers looking to expand. And then from that point, it's kind of key to kind of then understand how efficiently can capital be deployed to kind of buy land, and that's where interest rates and inflation come into play. Inflation is a headline item these days in the news, and for good reason. It's been kind of growing at a rate that's been higher than expected, and the federal government has been making some kind of tremendous strides to help control inflation. The most recent consumer price index numbers are kind of key litmus test for general inflation, has shown that our inflation rate is 7.7%, and that's, well, of course, well above the kind of target rate that the Fed sets, and this is largely driven by kind of energy prices, although there are other factors that contribute to it as well. In response to these high inflation rates, the federal government has increased interest rates on a number of occasions to help try to control for these high rates, and they do so by raising their interest rates. And so in this plot, we show this kind of most recent interest rate increase cycle here, this hiking cycle in 2022. It's actually one of the most aggressive interest rate climbs that the Fed has put out. So they're really trying to tackle the inflation challenge as aggressively as possible, and in fact at a historically steep rate. Now, what does that mean for you and I? Well, it means that borrowing money costs more. Higher Federal Reserve rates, interest rates lead to higher costs of buying land with a mortgage, or really kind of rates of any kind. And many of us will wonder, well, how effectively have they been able to curb inflation rates? Their most recent numbers on inflation were coming in kind of lower than expectations, so there may be some signs that of deceleration in inflation. Again, we can look to the futures market to kind of get a pulse on the market's opinion on the potential future trajectory of inflation. Unfortunately, we can't directly kind of forecast or know what will happen in the future ourselves, but markets are suggesting that we'll expect for the federal funds rate to continue to increase through to June, and then decelerate thereafter. But again, these are just kind of data points that we're putting together and looking closely to understand kind of potential future scenarios. We don't have kind of key facts of what will happen in the future. Again, the federal interest rates are closely related to and help drive the cost of borrowing, cost of lending. And so we can look directly to those some of those kind of lending rates, mortgage rates, as an indicator of interest. What's especially striking in the kind of relationship between mortgage rates and inflation is how they have moved together and interacted over time, and there's something to be kind of learned from those interactions. So here, looking back to the 1980s, we see kind of overall trends in decreasing trends in the 30-year mortgage rate, and similarly for inflation. However, in the 2020 period, there have been some kind of major shifts in the way that these two kind of key metrics relate to each other. And in fact, today, the rate of inflation is higher than the 30-year mortgage rate. We kind of collapse those two key metrics into a single number that we focus on in our analysis. That's the real mortgage rate, which is the mortgage rate minus the inflation rate. And this is kind of the real cost of borrowing. Here again, in the kind of in Illinois as a kind of an indicator of the broader trends. We kind of analyzed the history of land value changes with relationship to changes in this kind of key metric, the real mortgage rate, and found actually an inverse relationship in this case, which is to say that when the real mortgage rate is quite low, and in fact it's negative today, we see increasing land values. And so based on where we are today with negative real mortgage rates, the data suggests that farmland values may increase in the order of 8.8% looking into the future. And the relationship, and that's backed by this relationship between the real mortgage rate and land values. And in fact, if we looked back to the change between 2021 and 2022, this single indicator was a strong predictor of the same numbers that USDA was predicting. So we analyzed this data to show an expected increase in land values of 11.8%, and USDA reported a 12.4% change. So it's an important kind of an indicator to look at. So looking ahead, we've mapped out some kind of key scenarios that will lead to higher and lower farmland values in the future. These are kind of combinations of what might happen with inflation, what might happen with grain prices, commodity prices. These are, we certainly cannot forecast the future, but these are the kind of types of scenarios that we're really kind of monitoring for in order to have a kind of a near real-time feed on where prices and land values may be heading. So just to kind of cap off this section, will farmland values continue to increase? We think likely so, likely not as fast as in 2021, but remains a lot of uncertainty around the kind of future trajectory of land values. And well, are they overvalued? We think that they're, in many cases, and different from other periods in time, valuations in the kind of current era are supported by economic fundamentals, specifically these kind of key metrics of the kind of aggregate savings and the real mortgage rates. If you'd like to dig more into this type of work, we've published this in an article that's available called Farmland at Risk. You can find it searching online, or it's in the reports tab of fbn.com. You can also find it in FBN Community and the FBN Reports section. So far I've been discussing the kind of key drivers of land values and trends in land values at largely a kind of a national scale. I wanted to dig a little bit further into how these trends are playing out at a more granular spatial level, because of course nobody is buying the whole country's worth of farmland. We're all kind of really focused on what the next parcel is, or the kind of parcels that we're managing. Here's a map of how farmland values have our kind of estimate of farmland values at the county level across the country. We see some kind of key trends here. Unsurprisingly, very high values along the coast, driven largely by urban influence, and then kind of pockets of ground in the upper Midwest, especially that are much less influenced by urban pressures and are largely kind of high revenue ground. So one of the key messages here is the fundamental fact of real estate, right? Location, location, location. We're conducting quite a bit of work now on kind of unpacking some of the kind of drivers of land values and reporting trends in land values at a more granular spatial scale through a series of reports, the first of which was published last month. This will be a quarterly series where we provide both kind of analytics and kind of summary statistics on recent transaction data, commodity prices, and have a really kind of focus on the sub-state level. We published the first one focused on Illinois. We'll be expanding that to additional states soon. And I'm excited to share a little bit more about what this report series will help us monitor. At the state level, we're capturing trends in farmland prices really back to 2010, but we're quite focused on kind of understanding what the kind of current year's patterns are suggesting, both in terms of kind of how prices are changing across the 9 agricultural districts or regions within Illinois, but also how sales volumes are trending over time. So we see, looking again at real, actual farmland transaction data, that 2021 was a record year in terms of the number of farmland sales in the state. 2022 has seen a kind of a slowdown or reversion back to the mean, but is still kind of suggesting above average. We then provide in these reports kind of a breakout on patterns in each of the subregions, the districts within the state. So for each of the northwest, northeast, west, et cetera, we'll provide indicators, including the farmland prices, again, from actual transactions across a range of different soil quality bins, ranging from excellent to fair. And we also provide some kind of key kind of agronomically informed indicators on the relationship between yield and soil productivity and the relationship between yield and land value as well. So we're able to show, for example, how a kind of a key indicator of land quality, the soil productivity index set, relates to trends in yield, and then we're able to kind of report out on in more of a tabular format how a soil quality rating of, let's say, 140 points. This is a unitless index. It's comparable to itself, is related to farmland values as well as yields and kind of expected crop production, income, and so forth. So the purpose of this is to help give farmers a really kind of equip farmers with a differentiated data to kind of reason around what a fair, transparent price would be for a potential piece of ground, and also really just kind of help bring more data to the kind of back of envelope math that we're all doing when we're thinking about whether buying that additional parcel makes sense. So we'll be developing a series of articles in the near term that help kind of unpack these kind of key inputs to this type of analysis, really focused around soil productivity indices as well, that will kind of help develop that thinking. And also, again, we've developed this work in Illinois, but if you think that type of analysis would be interested in your area and for your operation, let us know. We're interested in really kind of focusing in on regions and production systems that represent our membership. So really would like to hear from you. And again, you can find this report on fbn.com in the community FBN reports area. Here's the short link to get there. And you can also sign up for kind of our financial insider mailing list to be the kind of first to know when new materials like this come out. So again, we're kind of continuing to zoom in, starting at the national scale, then really focusing on the state and kind of ag district level. But again, none of us are thinking about farmland at that level of granularity or at that level of aggregation. We're really thinking about, well, how does all this apply to that one specific parcel that we've had our eyes on? How do these kind of macroeconomic forces really kind of shape values in my neighborhood? And it's a grand challenge. And we think that there's a lot that this type of analysis and more can do to help us kind of understand trends at a very kind of local and in fact a kind of a parcel, a field level. And we're excited to kind of give you a preview on some of the kind of tools that we're developing for the FBN community help drive some of the of your decision making around farm real estate. We think that thinking about farmland values from those kind of economic fundamentals from a farm profitability perspective is a key way to ensure that to kind of help hedge against market exuberance, against bubbles in land values. That farm transactions themselves can suggest land values that potentially might not be supported by expected future revenue on those acres, and we want to know about it. We want to kind of, as general kind of land managers want to understand, what a fair price is for a piece of land. And so we've really analyzed millions of farmland transactions to help kind of extract some kind of key insights that we can then surface to the FBN community to help empower some of those decisions. And this is really a kind of a marriage between the FBN network data that allows us to kind of develop an understanding of patterns between soil productivity and yield, for example, the unique insights that FBN can provide about grain prices and expected market conditions, and it also leverages the expertise that the team has on farm finance to come together to be able to kind of speak to the kind of economic fundamentals of any specific piece of farmland in the country. And so encapsulating that in a kind of a mission statement, we're today kind of hyper-focused on bringing transparent, unbiased, and rigorous land valuation tools to farmers. And one point that I want to make clear is that these are only for farmers. That's kind of a commitment that we have at FBN across our differentiated products. Our goal is to empower growers to give more of kind of agency and influence in the marketplace for growers and only growers. I think that there is also some tremendous improvements in the timeliness and the transparency in the land financing life cycle as well that can be born from this. That can manifest in different ways, including streamlined land appraisals that help kind of reduce long wait times for appraisals. So you can head down to the FBN Finance booth to learn more about this. Our forthcoming farmland real estate analytics tooling that will kind of help surface a lot of these kind of key insights about soil productivity, kind of key determinants of land value, and serve as a kind of a tool to be a guide around land values. So lastly, I want to kind of emphasize that this work is kind of driven by demand from the FBN community. We've asked for this type of research, and that helps kind of shape the kind of work that we do. We're here to work for you at FBN more generally, and in data science in particular. You can think of us as your kind of dedicated science and research staff that has the world's data and public data and more at the fingertips, ready to do kind of analytical work for you. Let us help you scale from the kind of back of envelope math into something that can help other farmers in the FBN community. Would really love to hear any kind of other ideas that you have or more work that you'd like to see us do on your behalf. And happy to save some time here for questions as well around any of this. Thanks, really appreciate it. Again, my name is Jeffries, and if you have questions you want to talk about in the hallways, come find me. Always happy to chat.
The Condriff wave, he predicts when there's a correction. Do you believe in that wave? And is there going to be a correction?
I'm not familiar with that particular line of work, so I couldn't comment on the specifics. I think that the overall, if you look at the historical pattern in trends in farmland values or land prices or really anything, there tends to be kind of reversion to the mean. That's one of the kind of fundamental kind of facts of statistics. And so I think that in finance, there's a kind of this kind of sense of like you can, if you can be right about predicting that there will be a correction, but wrong about the timing of that correction, you're still wrong. And so I can say that, sure, there will be a correction because we're above average, but I couldn't give you a concrete number on when that would be.
It would be interesting to know if there's a correlation to high concentrations of large animal feedlots in the land price, if that was something you could work into the analytics. In our particular area, there's a large concentration of hog confinement buildings, and also that makes a larger concentration of farmers in general. And I think that helps spike the land value higher than just the metrics of interest rates and grain prices and inputs. Because we have an extra amount of non-farm value income, if you will, that's going into everyone's savings. We're getting to a time period where there's a lot of guys that have had big hog operations paid off for a long time. And now I think we're getting just an exponential spike in our just real localized farmland values. So it'd be interesting to know if there's a correlation between animal feeding operations and farmland around them animal feeding operations. That's a really interesting idea. I would love to hear what region you're in. We can take it offline if you'd like, though. Yeah, we're in extreme southern Minnesota. Okay, absolutely. Strong land values there. Yeah. Selling for 15.8. Yeah. Cropland? Yeah. With any improvements? 78 acres with just county tile, basically. 78 with tile, yeah. Fascinating, yeah. And how do you hear about transactions in your sales in your area? Word of mouth. Just word of mouth, yeah. Or go to the sale. Mm-hmm. Go to the sale. Makes sense. Thanks.
Similar to the last question, are you seeing any correlation between values and increase in institutional investors?
Yeah, it's not something that we've done specific analysis around, although it's a topic of great interest for us. We hear kind of anecdotally that there's a lot more kind of capital pressure kind of coming in from outside investors, and something that when we kind of look at auction results, we're particularly focused in looking at. I think that we're seeing strong prices even from kind of farmer buyers as well. But the kind of key question that would really need some kind of deeper data analysis is to say, what is the net effect of that extra demand from investors to pushing up, to see if it pushes up prices. I think that the intuition would be that yes, of course, there's more kind of money demand for capital to kind of enter the farmland assets. But I'd love to be able to give you a specific number, but would have to come back to you. Maybe we can catch up after.
So on one of your charts had, the average return being like 5%, I believe, with treasuries and essentially risk-free returns being 4 or 5%. How do you see that playing into land values, and they would possibly have more liquidity?
Yeah, absolutely. And I think that's, I'll see if I can find the slide here, if the clicker behaves. Yeah, I mean, there's inherent tension there for sure, and that's one of the kind of key things that we're kind of trying to capture with some of these kind of macroeconomic factors. I think that there's a question of the time horizon too, I feel like, with when looking at kind of returns to treasuries and in farmland. I think that the other part of the analysis is the cash flow component that one would get from investing in farmland that you wouldn't necessarily get just from the kind of appreciation from treasuries. But yeah, if you're looking at kind of pure risk-free returns, one certainly, and many are kind of taking a hard look at kind of balancing treasuries, risk-free return, and farmland. No doubt about that. Over time, we see kind of strong correlations between the two, though. Excellent. One last question from anyone? And happy to connect more out in the hallways or anywhere else. I know I'm the kind of last person between you and happy hour, so I'm happy to wrap here. And thank you so much for your time.